Don't you worry about that. When I tested this, there was quite a bit of lag between my voice coming through and you guys hearing it on the stream. So give me like a few seconds to reply to stuff when you ask questions. Yeah, I've had issues with the stream before, but I thought it might be better now. Let's see how it goes. Yeah, lots of Americans here. Oh, thanks, Nikki, for the recording. That's great. Yeah, well, I'm in Australia, right? So I guess maybe that's the reason why you guys are getting less of a connection. I don't know. If it gets too bad, let me know. All right, you guys ready? Nice, Indiana, Maryland, cool. Cool. Okay, John understands. That's all I care about. Man, there's some big guns here today. That's awesome. John's here, Nikki's here. I saw Addicted earlier. That's awesome. All right, let's get started. Options. So first, I want to say thanks to Nikki for making this awesome little card here because I went with the boring Google Slides version here. But I hope that's good. That's good for you guys as well. All right, what I want to cover for you guys today is options trading basics. Like it's not going to be in depth about like strategies and like some kind of system or anything like that. It's just going to give you guys a overview over the mechanics and how options work, so you can properly assess your risk and figure out your system for yourself. First, a disclaimer though, I'm not a certified financial advisor or anything alike. This presentation is for educational purposes only and not investing advice. So investing and trading with any vehicle is inherently risky, and you're the only person responsible for taking on that risk. So I'm not responsible for any losses you incur based on your information that you received today. So don't blame me for any bullshit that you're doing while learning this, eh? Right. So next thing, who am I? I'm Darth Trader. I'm Swiss originally, but I haven't been living at home for about a decade now. I've lived everywhere from Canada to New Zealand and now Australia. I've been an animator in films for that whole time. I've worked on stuff like Jungle Book and the last Planet of the Apes movie and the last two Avengers movies. I've worked on Aladdin that just came out, and right now I'm working on the sequel to Peter Rabbit. Over here as a senior animator. I've worked for Peter Jackson, I've worked for George Lucas, all those companies. But when I worked at Peter Jackson's company down in New Zealand, I actually started making some decent money. And I realized that if I invest right now, I might have it easier later in life, right? So that's how I got into the whole financial thing and got hooked real quick. But like everyone, the first ever thing I thought, okay, I'm going to buy Disney and hold it forever. And as you can see, I bought it over here and held through all of this bullshit. And then at some point here, I decided, you know what, this is not for me, and I sold it again. So I didn't lose much, but it was a pain to hold through this. While I was doing this, I was also, learning more about finance and investing. I started trading options in 2015. I learned a lot from the Tasty Trade guys, who are the guys who created Think or Swim and now Tastyworks, and they have lots of amazing content that goes really in depth with options. And this is how I learned most of my stuff. So I basically, for about 2 years, every day I watched like 4 hours of their content, and every weekend I watched like 20 hours of their content just to get everything into my head. And yeah, that is probably why I've become so good with options, just because I've been studying that shit in depth. I discovered day trading in 2017. I realized how much potential that has. I've been practicing that ever since, because it's like it adds a completely new aspect with just risk management and psychology, like especially psychology. So yeah, that's what I've been working on. I'm practicing that, and I finally found some profitability today, like this year. And yeah, now I thought I'm gonna show you guys some of the stuff that I know, because I see a lot of people in the chat who don't seem to have like the firmest grasp yet on options. And yeah, I just think it's going to be good for you guys to get some foundation. All right, what you want to expect from this is get a basic understanding on how options work and how to day or swing trade with proper risk management, and understand the most important Greeks, and see one way of trading options in a momentum trading concept. So I'm not going to go into swing trading and premium selling and all that cool stuff. I see I hope the video is good enough. If there's too many people complaining, I'm going to have to try to find a way, but for now, I'll just stick with it. But yeah, that's what you guys want to expect. So yeah, let's dive in. What are options? Options are like a instrument to like hedge a portfolio, and we have two kinds of options. One are calls, which are a contract to buy 100 shares of its underlying stock for a certain price at a certain time. So if you own a call and the price of the stock ends up higher than the strike price at expiration, which is all stuff we're going to go into later, the call allows you to buy the stock at like a discount for at the strike price that you defined at entry. So you buy the option with a certain strike, and when it expires, you can buy the stock at that price if the stock is higher than it was. The exact opposite is true for puts. It's a contract to sell 100 shares of its underlying stock for a certain price at a certain time. So if you own a put and the stock price ends up lower than the strike price at expiration, the put allows you to sell the stock higher than what it is trading at the moment. So that's the basic, like what you hear or what you can read on Investopedia as well. Right. So the definition, as I said, it allows you to buy or sell something for a certain price at a certain time. So when you look at this here, this is just the date at which you will be allowed to buy or sell that stock at. This is the price, which is called strike, at which you will be allowed to buy or sell that stock at on this date. So say you buy a 280 put, say 2 weeks ago. You bought that 280 put 2 weeks ago, and the stock is now 278.54. When this is expired on Friday and you had the 280 put, you were allowed to sell the stock for 280 instead of 278.54. Right, not the obligation. Exactly. So the option buyer has the right to do so. The option seller, because there's always like, it's a contract between two people, right? So the option seller always has the obligation to buy that stock, right, from that person who has who's able to sell the stock. But that is already going way too far right now. But yeah, like you have the right to buy this, or buy the stock if you have a call, and to sell the stock if you have a put. Right. Here's a quick example of how a call would work. So this is the strike price, the stock's price chart, and this is the call price, the call's price. So while the stock price, like does its thing, the call price kind of does the same thing. So they kind of move in tandem. Here's the strike price that the call is going to go. It's called in the money. So like say this is 10, this is 11. So and you have the 11 call. As soon as the stock goes over this, that's when we call the stock the option is in the money. So if the expiration was up here, say like this is maybe 13, and we have the 11 call, we could, and this is where we expire, we could buy the stock at 11 while the stock is already at 13. So you would already have like those $2 of gain, right? Next one. I keep getting complaints about the quality. I hope it's not too bad. But I'm recording, so I'm going to have a replay as well. So this is the same thing with a put. Stock price and the put price, you see that they are inverse, since like the put is profiting when the stock is going down. So you have like a put, and which strike is here. So as soon as the stock goes in the money here, that's when the put is getting its value. So if we were to expire somewhere here, we could sell the stock at this price while the stock is already down here. So these are the basic, right? That's like how this stuff works, and that's how this moves in tandem. Does that make sense to everyone? I hope the connection's not too laggy. Yeah, let me read through some of the chat. Okay, good. Yeah, I'm gonna have like a high quality recording for this, guys. So if you want to drop the I don't know, the resolution or something to get a better quality, that might be a good idea. Let me check the YouTube chat as well real quick. Okay, nothing, no questions yet. Okay, that's good. Let's move on then. Let's go and look how we actually name an option. So I've taken this from like actually one of the videos from Tasty Trade, because they're just really great. So this is how we define an option. It's the underlying, which is the stock that we're trading, the expiration date, which here is September 15, the strike, the option type, which is here is the call, and the option price at $2 per share. So buying one of these options would cost you $200, since it represents 100 shares of stock. This is automatically the max loss as well, since it can't go less than zero. That's like the same with stock, right? So buying the equivalent in stock will cost you much more based on the stock price. So say like if with a $50 stock, if you don't have any margin, it costs you $5,000. And if you're at trade zero, I think they have like 6-to-1 margin, that's about $830. So it's still 4 times less. It all depends on your margin, but that's like the great leverage that options provide, right? Because small accounts can actually trade some proper instruments and can make some proper gains. Next thing is picking an option. Like if you look at this, it's called a options chain. This is from Thinkorswim, and here you see all the different expirations over here. this is for SPY. SPY has like 3 expirations per week. So usually you're going to see weekly options and monthly options, which is called a regular expiration, just because weeklies are not are a bit younger than like they haven't been established as long as monthly options. That's the only thing. And regular expirations are usually more liquid than the weeklies. But for our day trading purposes, I always trade weeklies. Sometimes this weekly expiration or next week's expiration. So if you want to look at this and you think, okay, the SPY is going down, I want to buy a put. You want to you find the strike that you think you want to buy. So say I think SPY is going to go down to 286, so I'm buying the 286 put. Which here you see is the spread is between the bid and ask is between 70 and 75, so probably you can expect to pay 72, 73 cents for this, meaning because it represents 100 shares, you would have like you need a buying power of about $75, $73, $75. Yeah, so that's how you pick an option, right? Or usually I don't even go that far out of the money. I just stay here at the money because they are more liquid as well. But that's going to come later as well. So that's all there is. So you click on this, you buy the instrument, and you own it just like that. Yeah. Options pricing. This is now like going a bit more in depth about how options are actually going to, like, how the price of an option is calculated, because as you guys can see, they are not like the same price as the stock itself. But of course, because they are derived from the stock's price, they are connected to it. And here's what we like how this whole thing is calculated. And the price of an option is basically comprised of two elements. One is intrinsic value and the other one is extrinsic value. And together, like especially the extrinsic value, that's called premium. And that's what I want to look at first with you guys, because that's the complicated part if you're new to it. But yeah, just keep that extrinsic value name in mind, right? There's lots of jargon and lots of complicated expressions and lots of complicated words in options trading, especially. And as you're going to see later, lots of it is just a lot of fuss and not just a bit of hot air. And once you know what means, it's going to get way easier. So extrinsic value. It's mainly comprised out of two kinds of premium: time premium and volatility premium. So because you get the opportunity to buy a stock at a later point in time, which is quite an advantage, you have to pay a time premium for that. So the further out in time you buy an option, say if you buy a year in advance, you're paying a lot of time premium. That's one reason why we play a bit shorter term options most of the time, because they have less time premium in them. So yeah, like you want to buy something further out in more time, so that's the value you pay. And that, see how simple this can be? That's called theta. Time T theta. That's what theta actually means. So it's a fancy expression, fancy word for just time, right? Because options traders like to be fancy. I don't know. The next thing is volatility. That's like if you guys know or have looked at like VXX or the VIX or anything like that, it's like the fear in the market, and every stock has like a volatility priced in as well. Every option has that. It's just like what market makers price in to account for the possible move they think a stock can make in a certain time. So that's why Tesla has way higher volatility than say Coca-Cola, because Tesla, no one knows what the hell's going on with them, whereas Coca-Cola is a market stock that's just cruising. So yeah, that's volatility value. And as you see a stock go down, usually volatility comes into the options. So options get more expensive if a stock sell off, which is good for us, because if we buy them and they get more expensive, we can sell them uh, for a higher amount of money, which is our goal. But in the end, for our purposes, I think time decay matters more than volatility. So I'm going to have like a quick example of this later on as well. But say the stock doesn't move. That's what we call like time decay. So if you buy an option here, say 30 days out, and the stock doesn't move, or say you buy it like 2 days out, that's probably more realistic if the stock doesn't move. So you buy this option 2 days out of the money. So there's no intrinsic value in this stock, right? There's no, you'll see what intrinsic value is in a second. But like say the option is just out of money. You only have time value in it. The stock doesn't move. The value of the option is slowly going to decrease because we're getting closer to the expiration date. So that's like, people call it drag or time decay or whatever you want to call it, but that's like what we extremely want to be aware of, that if the stock doesn't move and we own this option, it's moving against us. So that's like a risk that we want to account for by timing when we buy this stuff. Right. And now I've already mentioned intrinsic value, and this is the math about it. So extrinsic value we've just covered. Intrinsic value is added as soon as a option goes into the money. So as soon as the option is higher, the stock price is higher than the strike price that you bought, it's in the money, and that's when intrinsic value is added to the option's price. So if you own the 284 call in SPY, and SPY is at 285.36, the difference between the call strike and the stock price is the intrinsic value. So stock is at 285.36, you own the 284 call, so intrinsic value is $1.36. Does that make sense? I think I have, oh yeah, the next slide is actually showing this. Right, so here we can see exactly like how this like everything is calculated quite accurately, obviously. So I've brought up the intrinsic and extrinsic value over here. We see, I think this is pre-market, because the bid and ask of SPY is 288.48, 49. So that means 288.49 or 48, and we look at the 288.50 put. It's trading at, what is that, $1.50. Of that $1.50, because it's the 288.50 put, we have it 2 cents in the money. That's the 2 cents intrinsic value here, and the rest is extrinsic value. So if you go from the mid price here, this is how this is put together. So you look at this going down, like the further it gets in the money, they get more expensive, and the intrinsic value is slowly getting higher than the extrinsic value. Does that all make sense? I see people posing question. Yeah, I am, John, I am tuned into Discord, but I'm just gonna run through this section first, and then I guess I'll take questions in 1, 2, 3, 4 slides. I hope that's cool. Right. The next, that's like the most important Greek for me that I want you guys to be very aware of, is delta. And delta stands for direction. Again, you know, like the only thing you want to care of is that D in front of, and ignore the whole Greek bullshit there. It shows how much an option price will change in relation to the stock price. So one delta you can think of being representative of the equivalent of the price change in the stock of one share of stock. So one delta equals one share of stock. So if you have like a 50 delta option, that means you basically are going to get the same price change as 50 shares of stock. That's what delta represents mainly. So if we look at the math, this is going to be fun. So you have one option, which represents 100 shares of stock, and say it costs $1. Times 100, you pay $100 for this option. If this option costs $1, you pay $100 for it, right? So if this is, say, a 50 delta call, that means if the stock moves $1, the call price increases by 50 cents because we want to get the equivalent movement of a $1 move with 50 shares of stock, which would be $50. I know this is freaking complicated. But what you just want to keep in mind is that delta does not represent the actual value of the option. It only represents how the option's value changes. This is the most important thing about looking at an option. To me, is that it only represents how the option's value changes, equivalent to the underlying movement. So let's do another example again, just to kind of, I don't know, try to drive that home. So if you have a 50 delta call for $1, you pay $100 because of this. SPY goes up $1. Because you have 50 deltas, in the end, your option should change in value like by $50. So because it's the equivalent movement of 50 shares, right? So if you go $1, 50 shares, that's $50, right? So the option price will go up 50 cents because it represents 100 shares, right? This is what you look at to manage risk. So now we know that if you want to risk $50 on a trade and we have a 50 delta option, the stock can move $1 against us before we have to stop out. This is like, honestly, whenever I buy an option, I always look at delta as my most important deciding point. I don't care how much an option costs. I only care about what its delta is, because that is representing my risk and not what the option's price is. So here you see like we're right at the money with this, right? So this is exactly the 50 delta, the 288.50. So if SPY was going to move $1, say it's going to move $1 down, right, in our favor with this put, 287.50, this would be about 50 cents of a movement. You see it's a little bit less because delta decreases as it moves out of the money, but that or in the money, but we don't care about that yet. Just keep in mind that if you buy this option for $150, because it's $1.50 times 100, it's $150. The SPY moves $1, you would probably make about would probably go up about $2, which $200 in the end is a $50 difference, right? All right, I hope I explained that well enough. Questions? Do you guys have any questions? I hope you guys can hear it. I still see people having issues with the stream. Does anyone have questions about options? Yeah, it's a bit too late to pre-record the stuff now. Well, in a sense, blue skies, yes, it is a percentage relative. As in, I prefer to see it directly, just as like equivalent of how many shares I theoretically own. So if I have 50 deltas, I theoretically own 50 shares of stock. Does that make sense? How much you risk is up to you, Jacob. Like the delta doesn't tell you how you structure your risk. It just shows you, it visualizes how much you are actually going to risk. So say you wanna risk, say, $1, and that is already telling you that okay, I want 50 deltas because that way it can move $2 against me until I get stopped out. Or say you see like you have a level 30 cents away. That's the level you want to risk off of. So if you're, say, you risking what, 60 cents, $60, you can get like I think, if I'm doing the math right in my head right now, it's 200 deltas. So 200 deltas and a 30-cent move, that's about $60, right? It depends. Just from to me, it depends whether you're at the money, in the money, or out of the money. Is just first is like a liquidity point of view, because the at the money options are usually more liquid, but also the deep in the money options are not gonna. I'm gonna go into this later, but there's a rate of like delta changes, right? It's dynamic, so deep in the money options don't change as much. Hey, Tweet, I'm not going to go too far into strategy today. This is just options mechanics. But like, if you want me to look at some of your questions out of this, just message me here on Discord and we can look at some stuff. The biggest mistakes. That's a good one. So one of the biggest mistakes that I've made is actually more theta related, because I like, if you buy an option on Friday afternoon, and you're going to see an example of this later on. You buy an option Friday afternoon and the stock doesn't move in your direction right away. You're just going to you're losing all your money just from sitting there. Let's go back to for Spartacus. The Greeks, wait, let me go back here. The Greeks here, see, this is a drop-down menu, so you can enable this. If you don't have any of these things, I think you can go up in here into layout and change your layout. Like, there's different presets that you can use. You can also like filter some of the options, and yeah, I think that's where you get that stuff. But for Dan again, yeah, I think the biggest mistake that I've made was that just underestimating theta decay. Because if you buy something on Friday afternoon and it doesn't move in your direction right away, you're screwed. You're going to see that. I think actually you're going to see that almost next up. Right, delta and theta in action. I think I'm going to do delta first, if I remember correctly. Yes. So this is a move in Tesla on May 17th that I documented for myself. It's on a Friday, and Tesla was finally breaking some like major support. And we're going to look at the weekly expiring options for this sell-off. I just want you to notice how the at the money, like the roughly 45 to 50 delta options, slowly gain delta and speed up the rate at which they increase in value. So this is like the get-go, right? So let's when I did this for myself, I looked at this one because it's the perfect. It's like right at the money right now, yeah, it's just a good example. So see, like this. Let's just watch the 217.5 put here. It's currently trading at, I don't know, about $1.10 before the sell-off starts, right? So like, okay, like based on strategy or whatever, you see, okay, this is about to break support, so I'm buying an option. Start selling off, it goes $2 in our favor, and as you see here, $2. You can see. I'm sorry about that, guy. I took the screenshot from Thinkorswim on demand, but we've already established that the at the money option is usually the 50 delta, right? So just keep in mind that, remember that it was the 50 delta. So we've moved from 217.30 to 215.50. So it's about $2, right? And we see the price change from $1.10 to $2 and what was that? $2.25.30. So that's like about $1 of change, right? It's not completely accurate, but that's exactly how the delta works. So we sell off $2 and we gain $1 of value in the option because it's 50 delta. So it's the equivalent move of 50 shares, which is what you see here, right? Now, the sell-off continues. The option is now $3 and almost it's $4 worth now, right? So we went from a change of $1 in a $2 move to, and it's again another $2 move, but now the option has changed almost like how much was it? Has changed like $1.50, almost $2. So that is because as the option moves further into the money, the delta increases. So that means that the rate of change increases, which means we're gaining more money as the option moves further in our favor, right? So that's kind of that's why I love delta so much, or just why I love options so much, because they are dynamic. So it's not like stock where you always have the same rate of change, because this option moves into the money, the delta increases, and that means the rate of change, the value increases faster the more a move goes into our direction. At some point, it's going to slow down again, though, because, like, say from here down to here, it has like, this is usually around the 80 delta. This is the 50 delta, so it has like 30 deltas to increase. From here, like it usually, like, it can only go to 100. It can only be equivalent to 100 shares. It can't be anything more. But that's like another reason as well why I like to trade the at the money. It's just you have a nice delta increase to go through. But that's the power of delta. So I actually traded this, and it's just an amazing gain that you can look at with a $100 investment. It's almost 300%, just like that. So that is the power of delta. The next thing is theta, and now you're going to see me take a crappy trade, but well, can't all just take good trades, right? So what this is a trade that I love taking in high volatility when SPY either sells off or spikes up really hard, really fast. So I got my signal here, and I bought calls, a bunch of them, right at the money, and this is expiration Friday as well. So as you guys see, there's an hour left in the day. So in an hour, all these options expire. So let's look at the chain. So this is the sell-off, right? This is where I buy. I sold about a third into this spike here, but I bought the 286.50 calls, right? So they were what's that? $46 per contract. Again, it's probably 50 delta, but we don't care. We care about data, the time decay in these options right now. So I bought those, probably about 10 of them, and was looking for a retracement to VWAP. That's usually what this setup does. But the market does not go anywhere. So it sells off, comes back, sells off a little bit, and this is literally just before the options expire. What you want to note though is that we're basically at the same price, right? So the price of the stock has not changed, but look at the option. Like all the time value has come out of them. So I've lost on that second third, I lost about 50%. That is like the theta that we want to keep in mind. That's just often a drag on our options when we buy stuff. Does that make sense? Okay, let me go through some of the questions. I'm mainly looking at the Discord chat, guys. So if you chat in YouTube, I don't think I can look at everything. Right, any questions? There's some people typing. Spartacus, the calls were expiring that day, so you can't hold a call past its expiry date, right? So that was my mistake. I should have just bought the calls of like next week's expiration, but they are not as cheap. So um, see, there you go. I was trying to buy cheap options for like a quick move. Usually this is a scalp setup, and that was just what I was thinking about. But actually, this is an adjustment that I made for that setup for myself for this strategy. That if it's Friday afternoon and I get a trigger, I'm just buying the next week's options because it's just too risky with theta. I don't get your question, Benno. I rarely let options expire RFAN, like because it's a momentum trade. You don't usually wait for expiration unless it's like Friday afternoon. But even then, I think you want to get out of stuff. I don't know. There's also I'm not sure about fee structure with some of those brokers when it comes to assignment because I think they have to do some back end, like bookkeeping if those options expire, and I don't know if that's going to charge you anything. So I just always close out my positions. Most of all, like usually, like I don't get to the expiry date. These are momentum intraday trades, which don't go like I don't swing. I don't buy swing options for more than like 2 or 3 days. Um, I'm usually looking for the 50. Sometimes I go out to the 30, but I rarely go out further than that unless I'm like trading Amazon and I just don't have, like like if you trade a 50 delta on Amazon, it's gonna move like hell. So that's when I only go down to that's when I go down to say a 15 or something like that. But rarely, rarely I trade anything further out of the money. I don't know what you mean you want to buy millions, Benno. Everyone wants to buy millions. Actually, no, I want to sell millions. Any other questions for now? All right, let's move on. Um, this is like the next part is about. Wait, there's something else. Um, Blue skies. We could look into that. Like Addicted and me and Nikki. We usually post quite a bit of charts during the day. So if you just follow the options room, I think you're gonna find quite a bit of value there. All right, let's move on. Day trading options. So yeah, this is a quick but not comprehensive look at how I trade in 3 trades, and I'm gonna add some other stuff. I think this is already the last part of this. So first thing I want you guys to realize is that you need, as with stock trading with offshore brokers, you need to try and get past PDT. And I actually think options are a much better way for small accounts than stocks. But of course, as you say, you have to get past PDT with it as well. And with options, you can actually do that without having to go and give your money to an offshore broker, some discount house like Robinhood that suddenly freaking, like goes in. And I've seen horror stories about them covering positions and stuff like that without even telling the users. And so yeah, so you can open an account with reputable brokers like TDA or TradeStation, and they trade options without PDT restriction, and that is if you open a cash account. So what that means is it has no margin, and that you can only use your funds once a day. So say you buy an option for $200, those $200 you can't reuse. So if you have a $5,000 account and you buy 10 $500 options, that's it. You can't trade anymore for that day. But usually, like, options are more in like the $100, $200 range. So you should have a decent amount of trade. Should be able to take a decent amount of trades. Anyway, so that's not a big issue. And the pros for the whole thing is you have no PDT. You always get the good fills because you're with your reputable brokerage. The funds settle overnight, so the next day those funds will be available again for options. For stocks, on the other hand, funds would settle, I think, 3 days. In 3 days. So that's just another thing that speaks for options, right? And because if you trade options, you don't need a huge account to get started. So that's what I would recommend for you guys to do if you want to start day trading options. Like I personally, I take about, if I get lucky, I'm taking 5 trades a day. That's a lot actually for me. So 5 trades a day, and maybe like, I don't know, $1,000 per trade. So you don't need a huge account, right? So that's that. Let's get into the trades. The first example trade is Roku. Day after earnings, and switching the bias intraday. So it had a huge day in earnings and broke up to new all-time highs while the market was still weak. It was China trade war news, and I just wanted to trade the continuation on the second day since it had such an amazing relative strength. So yeah, that's what I was looking for. I was looking for a long. So when it opened lower and started spiking to new highs right away, I waited for that, like a quick pullback to VWAP, and bought some calls. So this is like a really fast, like it's called an opening drive. I think people call it an opening drive. So I pieced out really quick right away, as it spiked into 85, and then I saw it, like it went to 86, couldn't hold, and I pieced out the rest into like that lower high. And that was like the first trade of that day with just like a quick momentum trade. And later in the day, I realized, okay, this can't hold. It's not, it spiked through highs and tried to keep going, but couldn't hold, and the market was still weak as well. So I'm pretty sure that had an influence as well, that the market was just weak. And at 10 a.m., it started selling off quite a bit, and didn't really give me like a big opportunity anywhere here. But when it put like a quick, like pullback into at least a little bit closer to VWAP, I started a position. Just like nothing big yet. I wanted like a proper pullback into VWAP to start sizing in. So I sized in on the next pullback. But then of course it spiked through, so I sized back down. I didn't close everything. I was risking high of day, so I just I pieced out, I think it was half, and then I pieced back in when it failed back below and started holding. Now you see like it could not hold back over VWAP, so I was happy. But because of the emotional stress that I just went through with this, I covered this like the initial like half quite early, as soon as it broke support somewhere down here, and then the rest I broke in. I got out into lower days. So this is how you could, like, one example of how you could trade options, right? It's, you can't time them perfectly. Like, you, not like with stock. I never attempt to time them to the penny. It's more of a like a conviction trade. You see a stock move a certain way, say you see it hold a resistance, that's where you get where I get in. And if it breaks the resistance and holds above it, I get out. If it breaks and comes back down right away, that's okay for me to stay in. But as you see here in this trade, this is how I kind of traded this. The next one is a fundamental catalyst. I traded UNH. There was a healthcare sector reaction to news about the Affordable Care Act. And yeah, UNH and a lot of the other healthcare stocks all sold off. And I really liked UNH just for its daily pattern. If we go back, see, like, it had this nice little trend line that it was about to break on these news, also rejecting the 20 MA and all that stuff. So the plan for me was to start put position into into a spike, preferably into like a previous support that's now resistance, which I kind of saw here, 247. So I started with the initial position here, and then when it broke a low of days, I added, and then as you can see, I pieced out way too early. I pieced out here and then got too impatient and got down here. But now you see like what these options could do. Say, so the second position I bought at 262 per contract, and that thing almost doubled, and just with this little move. Now imagine I would have held all of this until down here. So that's the power of options in this trade. And the last trade, breaking news trade, that's my biggest trade so far. Stuff like that is like, that's not really like a setup that you can prepare for. Or I guess I feel I got lucky with this one, but people say luck is when preparation meets opportunity. So I guess I was just ready for this. CTSH, it was due to announce earnings after the close that day, and about 20 minutes before the close, someone leaked results, and they were horrible. So a trader friend of mine who is really good with breaking news told us, and we had just a few minutes to kind of position ourselves. So what I did was I bought like an initial position in my swing account, just here, and thought, okay, maybe people are not going to find out, you don't want to be too crazy about this, but volume started picking up, like 2-3 minutes after. So I bought like 2 more tiers in my day trading account, and just rode that whole freaking move down. It was insane. It was beautiful. Covered the day trading part of it into the close, and held the swing part overnight. And look at how these options move. Like the first tier was 80 cents. The 2 other tiers were 90 cents per contract, and like the last tier, the swing was literally $9 difference per contract, right? So insane, right? Those are the three trades. Now, how do I find plays? Usually on a daily basis, and that's what I want you to guys to realize as well is that you want to trade smarter or work smarter and not harder. So I used to kind of freaking scan everything and flip through charts all weekend. And now what I do is just I have my perma watch list, and I have a relative volume indicator that I purchased. I love that thing. So it gives me like a pre-market value of volume in relation to its 10-day average. So if something has a lot of volume in pre-market, it's usually in play. So this is actually from this Friday. And if you guys were in chat, you saw me trade MA and look which one had the highest value. And I think I also mentioned it in chat. This one's going to be in play today. I love this indicator. This is the biggest part of my scanning process of just finding plays. I do use FinViz a little bit, and I also read the news on Thinkorswim, but reducing my watch list and focusing on these perma watch stocks has made my life so much easier. Just work smarter and not harder. Yeah. So in conclusion, options have huge potential to build small accounts, and their value increase speeds up when they catch a move. And that's why I like trading the at the money options. Sometimes perhaps I'll go out to the like 40-30 delta, as I told you guys, but in general, I like being just at the money, as these options are also the most liquid. I think cheap, like far out of the money options do have potential, but they're also risky. Like if you don't go out, get all the way there, if the move happens but you don't go get as far, don't make any money, or don't make as much. It's just riskier, especially on an expiration day. And far in the money options are also not as attractive, as they don't offer the nice delta increase that we get from the at the monies. And as I've just mentioned as well, options can't be timed as precisely, since you just don't like the spreads are sometimes a bit wider, and because it's derived from like another stock's price, it's just these are not meant to be timed by the penny, right? You just need to set a little bit wider risk with that as well. But to me, that also gives me a bit more peace of mind, because I don't have to be crazy accurate to catch a move. Other than that, I just trade options just as I would trade stock. I rarely look at like the options charts itself, because all my decisions are just based on the stock chart, because that's what the options price is derived from anyway. So why would I look at anything else than the thing that actually drives the options price? And I also only trade stocks that have liquid options. So again, on Friday, you saw me post in chat about SFIX, and it was in play. I don't even know what it did, but it was in play in pre-market because of some news. It might have been earnings. And I looked at the options, and they were like 30 cents wide. So you kind of drive a freaking bus through that spread, and it puts you at a disadvantage right away. So that's like one thing you really want to keep in mind when trading options. Yeah, I think these are all the conclusions I have. And now I have a little surprise for you guys. Does anyone, before I hit the surprise, does everyone have like a question so far? So tweet, what falls under liquid options? It's just if you look at the spread of an option, um, usually liquid options have like a tight spread, and for most of the parts, that's like 10 cents maximum. Like a 10-cent spread is actually already getting a bit extreme for me. I like really tight spreads. Sometimes, of course, like you can't always get it, but try to get as tight a spread as possible so that the bid and the ask are as close as together for as possible. Um, you can Charlie Boy, you can paper trade options in Thinkorswim. Thinkorswim is amazing for that. Like they have like the on-demand feature, and they have simulated accounts that you can request. I think the sim accounts you need to request a live data. But yeah, in general, they're amazing. Okay, cool. No more questions there. All right. So the indicator, as people are already asking about, this is actually the surprise. So I negotiated a affiliate discount with the guy who coded the R-roll indicator. It's from EasyCaters. So he's an amazing guy, Josiah. He has tons of shit on his website, and I was getting able to get you guys 10% off that thing. It has like a chart indicator as well. But yeah, like just for sitting through with me here, I thought I'm gonna get you guys this. Just like these are the instructions, like either this link or add this at the end of any link on the website, or I think coupon code Lucas. That's my name. Should work as well. I hope that's cool for you guys. Um, so yeah, that's that. Any more questions? Well, let me post that link maybe in chat so you guys can click on it. Yeah, so Thinkorswim support is amazing. They're really, really good. They're really fast. They even reply to me on weekends. So Spartacus, the difference with paper trading options to real life trading options, it's just you might. What I've been noticing when I've been backtesting stuff is that you get fills, quite good fills, and you get like quite instant fills. Um, I think they try to simulate like whenever I think like a tick hits your price, that's when you get filled. You don't get filled immediately, but it's just you might not get the exact same fills in a real market. That's the only thing that you want to keep in mind. I very, very, very rarely use market orders because again, I like to be in control. If you hit a market order, you don't know where you're going to get filled. Usually, Thinkorswim and TradeStation, they're quite good with your fills, even with market orders. But if you can't trade with one of those, I've heard like stories about, like some of those offshore brokers, like they don't always trade or like fill in your best interest because they sell orders or stuff like that. I don't know. I don't want to put any rumors out there, but it's just with market orders, you're kind of giving away control of where you get in. And that's why 95% of the time I use limits. Yeah, as Nikki says, Spartacus, that's exactly what I mean. It's like it's not a real market environment, right? Exactly. Exactly. Nikki puts it exactly like that's why they can be sketchy because they they fish you, they bring you in with no zero commissions, but why don't they have to charge commissions? Because they make their money somewhere else. It is by selling off orders or betting against. I don't know if that's actually legal, but I heard stories about brokers betting against what their traders trade and stuff like that. So Thinkorswim, the big ones, they don't have to do that, right? Um, then regarding consistency, I've only found consistency this year, and I've definitely done better early in the year when there was more volatility. Right now it's summer trading, so last week uh, I didn't I was green, but only barely. The week before, I had a decent week, but nothing, to write home about either. As soon as volatility dies down, there's also, like it's just not there's not as much moving, and I haven't had like that setup that I showed you guys. My favorite setup that in the spy that I usually trade. I haven't had a trigger for that in about 2 months. So yeah, like it's I don't know. It's I find summer trading is difficult. No, no, no. I don't usually do $1,000 positions. I'm a small trader like you guys as well. That was just an example. Um, the position size depends on your account. So if you have a $5,000 account, you want to have a max, say like what I'm setting is like a max daily loss, which I would maybe set at 10%. So if you have a $5,000 account, 10% is $500 max loss a day. So now you can say, if I can lose $5 max, I want to be able to take at least 10 trades. So that means I want to risk 50 bucks, $50 a trade, because 10 times 50 is $500. So that's how you want to structure your position size. So $50 is not the price you pay for the option; it's the risk that you take, as like with Delta. So I could risk $50 with a $1,000 option, and I could risk $50 with a $50 option. Like you could also just, if you're really confident and you don't want to care, you can buy a $50 option and just, if it goes to zero, you don't care because it's your max loss. Like that's something you could probably do as well. Nice one, Dan. Off the wall. Love it. Right. So, is there any other questions? Here's more information. If you want more information, you gotta go to Tasty Trade. They have tons of great material. I've taken like some of the stuff I took screenshots from their videos today, because it's just they are the experts. They freaking built Thinkorswim, and they built Tastyworks, and they have like 9 hours of content every day. They're really good. Um, Private mentoring. I've been asked by people if I was gonna do some private mentoring, and I've been hesitant. Like I don't know if there's actually enough interest or anything like that. But if you guys are interested, message me on Discord or on Twitter. Um, yeah, and just like we're gonna figure something out how to, like I do have quite a bit of an idea what I would want to teach you guys, but honestly, like I don't know. As I've told you, like I'm not a big trader myself, and I'm not making millions, and I'm just like you, except that I've spent a few years studying options like really, really in depth. So don't expect miracles or anything like that. But if you're interested, hit me up, and I'd be happy to help with anything if I can. So yeah, just to hit me like a direct message, and we'll take it from there. But yeah, guys, that's it for now. If there are any more questions, let me know. It's been what is it, a bit more than an hour. So yeah, hit me with any more questions right now. Otherwise, I'm gonna put on the sweet, sweet music from Nikki again. Okay, I'm glad it helped, Spartacus. Oh, thanks, John. That means a lot from you. I'll post the recording as soon as I have everything processed. I'll probably put it on YouTube or somewhere, and I'll give you guys like a unlisted like link or something like that, so you guys can rewatch it. I know some people have probably had issues with the connection because I don't know. I guess Australia is too far away, but yeah. Yeah, and guys, just join us in the large cap room, options and large cap room as well. I feel like we have a fantastic team in there now with Addicted and Nikki and some of the other guys who really start providing lots of value. Dan, I don't have a company. I don't know what you mean. I'm a retail trader. If you want to apply to the company that I work at, it's called Animal Logic, but you need to be able to do something in the visual effects kind of realm. Oh, Spartacus, there's of course like I think there's advantages to stock trading as well, but I don't know, for small accounts, I prefer options. Yeah, Paula, it's recorded. Great, Arfan. I'm glad it provided some value. Thanks, Nikki. I hope it wasn't too fast or anything, but yeah, I think this is it for now, guys. Um, yeah, just hit me up with questions if you have them. Um, take advantage of the discount if you want that Arvol indicator. Josiah was really collaborative with this. He was really open to give you guys that discount. Yeah, Arfan. Yeah, message me directly and I'll show you my demo. It's about 2 years old now, but I have one. All right, all right. Let's hit it, Nikki. Thanks, guys.